Budgetary control and responsibility accounting. The term budgetary control itself is really where we're talking about just taking budgets and using those in our operations and to control operations and oversee and a lot of different things that we can do with budgets. But budgetary control, that's pretty much what we're discussing with that. And we do that by using various budget reports where we're going to look at actual numbers, compare it to budget, and then determine whether we have a favorable or an unfavorable variance. And that can really depend on what we're talking about. If you were talking about revenues, if you budgeted $10,000 and you got $12,000, well, that's a favorable variance. You got more revenue than you thought. But if that was an expense instead, then that same example would lead me to have an unfavorable variance because you had a larger expense than you expected. So budget reports are how we're going to use this information and then again be able to implement and change and plan and adjust our operations based on results and the difference or the variance that we can report in these. Responsibility accounting, I'll save a little bit till later, but again, you're going to see how we're going to use budgets in a specific manner for responsibility accounting at various levels, but I'll hold off on responsibility accounting for just a sec. Now, those budget reports we talked about, you can use what's referred to as a static budget or a flexible budget. If you're going to use a static budget, then that is just one level of data. So let's say you were going to give me a production budget. You would give that to me at, say, 5,000 units, but that's the only level of activity that would be contained within that static budget. Okay? It doesn't have any different level of activity, just that one. So as long as you're at that level, then everything would be fine. But if you're not, then you'd have a problem. Okay? So if you don't vary much in your production, that might be okay. But if you do, then you might want to look at having a flexible budget. And what a flexible budget does is it lets you have pretty much multiple static budgets. So you have a wide range of activities. You've got different levels that you can look at. So if you thought maybe you were going to be at 5,000, but you ended up at 8,000, or if you have a flexible budget and that's within that range of flexibility for that budget, then, then you can adjust based on what that level of production or activity, depending on what type of budget we're looking at, actually was. With a static budget, you don't get that, again, level of flexibility. That's where the name flexible budget comes from. You're just at one level, and there's, not much you can do about that. So the flexible budget does give us some better comparability, and again, if you have different levels of activity, then the flexible budget is easy. You don't have to totally redo anything. Okay? Now, responsibility accounting, and I'm just going over these briefly. Look through for some examples, but that's really the difference. And with both the static budget and the flexible budget, again, you're going to have the budget amounts, what you budgeted, what you thought you were going to have, your estimates for the period, and then you can compare that to the actual numbers that you had for those. And then you're going to be able to see the variance. Again, the variance will be favorable or unfavorable. Okay, so you can easily see, okay, how did we line up to what we thought we were going to, actual versus budget, and then based on that, we can make good decisions for the future. Okay, see maybe if we have a problem or we're doing really good and we need to continue doing what we're doing, or there's an area for improvement. So a lot of things we can use based on those budgets. Now, responsibility accounting, what we're talking about when we discuss that involves looking at budgets and costs and reports and revenues and all those types of things on the basis of who's responsible for those items. Okay, so we could be talking about a unit, or a lot of times you talk about the manager that's responsible for that area, and that's what responsibility hones in on. And it can be used at various levels, different levels, every level of management, so long as you've got a couple of conditions in there. You've got to be able to have costs and revenues that you can tie in with that level of responsibility, whichever level you're talking about. So you've got to be able to trace them. And they have to be controlled by those employees at that level. Okay? Also, we've got to be able to have budget data that would give us good numbers to judge how well that level of responsibility or that area is actually doing. So there's a couple of conditions that you want to talk about with this. And responsibility accounting, again, talks about, you can use that in the term of different levels. You can talk about it in segments. And a lot of times when you use that term segment, you talk about when you have operations that are decentralized. So instead of having maybe one corporate headquarters and they make all the decisions for the whole company, you've decentralized, and maybe you have regional headquarters, or you let your plants in each geographic segment or area decide things for themselves. You give them a certain level of responsibility. So again, the amount of decentralization will also impact how many different areas or levels that you have. But a lot of times when you hear that term segment, that could refer to a decentralized operation. Okay? But again, even if you're not decentralized, you can do this for various areas or levels or product lines or a lot of different things that you can look at with different areas of responsibility accounting. But again, you'll see this area of decentralization come up. I mentioned this already in one of the conditions, but there's a difference between controllable and non-controllable costs, and that's very important in responsibility accounting. So it's a big issue that you want to isolate just those items, whether that be, we'll talk about specific things that you'll see on responsibility reports, but you want to isolate just those that manager or that segment or that level could control. So you want only controllable costs on these budget reports for these responsibility areas. Because if you couldn't control it, then you don't need to be assessed on it. Okay? Because it was out of your hands. You didn't have any control. So if that was bad for your area, then you shouldn't be the one that takes the blame for it because you didn't have any control over it. So we want just those controllable costs in our data for these budget reports for these responsibility centers or areas. Okay? There's another term that you'll see referred to with responsibility accounting. It's called management by exception. And that's when you have management that looks through your budget reports and your information, and their focus is really on just that difference between the budget and the actual. So that variance. They're looking for where that shows then there's a problem. Management by exception. Where is there an exception? Okay? So, again, it might not be the best holistic view, and it doesn't mean that management's going to look at every single difference. It can be a very effective method. Again, it just varies, but there have to be good guidelines for identifying what is an exception. So, there are a couple of reasons. The two biggest things that would be used would be materiality and also controllability. Again, we talked about control was an important area. So if it's material, again, if it's immaterial, then that's not something that's necessarily important. And again, it's important that those items are controllable. Okay, if management can't control them, again, it's not really the best measure to use. So what are these actual responsibility centers? We talk about responsibility accounting. We're dealing with these different areas or segments or levels, whatever you want to talk about it. And there are three types of responsibility centers that we have. The first one is a cost center. And it's named so because these centers or areas or levels or segments, or again, there's a lot of different ways to talk about them. They are only directly involved or have control over or authority to make decisions on costs and expenses. Okay, so again, costs and expenses are not necessarily the same thing, but they have responsibility for costs. Okay, so their budget report's going to reflect that. When you see a cost center responsibility report, you're only going to see costs on there, and specifically, you're only going to see controllable costs listed out. You're going to have a budget amount, the actual, and you're going to have the difference. And we're going to show each line item whether that's a favorable or an unfavorable variance. Okay? The second type of responsibility center is a profit center. Now, what is profit? You should definitely know the definition for profit by now. And profit is revenue minus expense. So now we've taken it one step above a cost center. They still have responsibility and the authority and the responsibility for making decisions upon costs and expenses, but now we've added in revenues as well. So now you've got the responsibility for the profit for that area or that center. Again, we want to focus on controllable costs and controllable revenues. Responsibility reports for a profit center they look similar to an income statement. You'll start with your revenues, your sales, and we'll have this divided out in variable and fixed costs. So you'll have those variable costs listed first. You'll get contribution margin just like you would before. But then after contribution margin, you'll have fixed costs, but only those that are controllable. So if they're not controllable, we're not going to have them. You're going to list out controllable fixed costs, and that's going to give you something called controllable margin. Controllable margin. Okay? Again, you'll have budget amounts, you'll have actual amounts, and you'll have the difference, which will be a favorable or an unfavorable variance. The last type of center is an investment center. And again, we're doing kind of a step up, so this is a step above a profit center. An investment center has the same things that you saw in the profit center. So they have control over or responsibility over costs and expenses, revenues, but now we also throw in there assets. So we give them responsibility for their assets and the return on that investment in their assets. So not only are they, again, responsible or have decision-making abilities for costs and revenues, but also for assets. So their report will add a little bit more, one more thing actually, than the profit center. So you'll still have sales, your variable costs, contribution margin, you'll have controllable fixed costs, you'll have, usually a lot of times you'll see other fixed costs on here, and when we talk about other fixed costs related to investments, are something that's relatable, again, specifically because it's now an investment center. So something that you wouldn't have had just at a profit center. So you might see a few, but still it's a controllable fixed cost. And again, we'll get controllable margin, just like we had before. We'll have budget and actual and a variance column. But at the end now, we'll also add another line which relates specifically to our responsibility for these assets. We'll put in there also a return on investment or an ROI calculation to show how well we've done with getting a return from those assets. So we'll do this calculation as well. We'll have a budgeted and an actual and see how well we did to what we thought we would. Again, a variance column for the ROI for our investment centers.